Hello. Good afternoon. Welcome to our presentation today called Tax 101. My name is Mary Ann Rodriguez, and I am a program associate with the Capitol Hill Campus program at the Mercatus Center at George Mason University. For those of you who are unfamiliar with our organization, we are a university-based research, outreach, and educational organization designed to provide policymakers with academic resources to help them in their work. Today's presentation is the first of 3 presentations in a series entitled Exploring Issues in Tax Policy. Tomorrow, Dr. Garett Jones will return to present on the 1986 tax reforms and provide a historical overview of this piece of legislation and what it means for current policymakers. And on Thursday, Professor Daniel Shaviro will join us from the New York University School of Law to discuss issues in corporate taxation and corporate tax reform. And so we hope that you will all join us for those presentations as well. And we have another event coming up on December 18th. Dr. Bruce Yandel will present an update on the economic status of the United States. So we hope that you will join us for that as well. And as a reminder, we ask that you do fill out the green feedback forms that you see in front of you because these do help us evaluate our programs and continually improve, so that would be great. Dr. Garett Jones joins us today from George Mason University, where he is a professor of economics. And prior to joining GMU, he earned his PhD at the University of California, San Diego. He was a professor at the Southern Illinois University in Edwardsville, and he served as an economist on the Joint Economic Committee and was at one time a legislative assistant and economic policy advisor in the office of Senator Orrin Hatch. So please welcome Dr. Garett Jones.
Well, thanks very much for coming out here today. Let me tell you a little about myself and my background. I'm not the usual person who gives a talk on this subject. Usually you bring in a tax economist, somebody who focuses on the microeconomics of how the tax code has been written over the years, how individual small targeted incentives impact people. What I am is I'm a macroeconomist. Most of my work is on questions of economic growth, on the Federal Reserve and how it impacts the economy. So I take a little bit more of a big picture perspective, and that'll show up in the talk today. After I wrote this, the outline for the talk today, I realized that what I'm doing here in 1 hour is I'm trying to sum up basically half of a semester's worth of research that I just got done teaching my PhD macroeconomics students. So this might be a little bit of a quick ride, but I hope we manage to get through without a lot of bumps. So just to give you a quick overview, I'm going to tell you 4 things, one of which you already know, which is that you need to pay your bills someday. That's very important for government to keep in mind when you're thinking about any kind of tax policy, that ultimately it's the size of government spending that determines what your long-run tax burden is going to be. So you can't just change taxes and hope you never have to, you can't just cut taxes and hope you never have to pay for it. I'm going to talk a little bit about taxes here and elsewhere, just show you what's happening in other countries around the world. We'll go over some of the evidence on how much people really respond to tax changes, and then we'll look at how taxes actually impact the economy, and we'll find that the evidence is actually kind of muddled. So the first thing I'm going to teach you is an idea that goes back to David Ricardo, who lived actually during the time of Adam Smith, but died a bit later, died in 1823. So David Ricardo had this idea, which is that even the government has to pay its bills someday. And the way to say this with just a little bit of jargon is that the government faces a budget constraint. It has to pay through things either through taxes or through borrowing. Robert Barrow of Harvard is famous for having brought this idea back into macroeconomics. And ever since he brought the idea back in the 70s, it's something that the profession keeps wrestling with. So just to illustrate this, if your government is spending $20 this year and $20 next year and then time ends, what's the best way to pay for that? Well, if you might ask yourself, gosh, he's right off the bat, this is an economist, and he's being completely unrealistic, just like I expect economists to be, right? The world doesn't really end next year. But even if I add all that stuff in, it's just going to make things a lot messier, and it's not going to change the story. So if you want me to do the full thing with infinite horizons and whatnot, I can do that, but I'll do that after class. So one way to pay for this is to have taxes of $20 each year. Second way to do it might be to have $10 in taxes this year, $30 in taxes next year. I'm ignoring interest here, right? So the government borrows some money this year, borrows it from the public presumably, and then it repays that next year. It has to raise taxes next year to pay back what it borrowed. So keep in mind here, what we can't do is say, well, we're just going to have low taxes this year and then $20 next year, and then once the world ends, we'll be like, oh, well, sorry, we didn't pay you back. That's not an option. Okay? So what this keeps in mind, what I hope you keep in mind from this is that it's the spending that is the burden of government. That is what the government has to repay. It's based on the amount of spending. So spending determines the what constraints the government really faces. So Milton Friedman ended up contributing to this debate. Milton Friedman, who we lost just a little while ago, another one of the 3 or 4 Nobel Prize winners I'll mention today. So if the government switches from option 1 to option 2, if they switch from the world where you have tax smoothing of $20 a year to the world where you have low taxes now and high taxes later, we can call that tax roughening if you want to. We can call that tax shifting. You can't call that tax cutting, right? It would be wrong to call that a tax cut. It's just a tax shift. My colleague at George Mason, Tyler Cowan, has been making that point for the last couple of years. Well, what would a reasonable consumer, I'm not saying everybody's a reasonable consumer. We all know some unreasonable people. But what would a reasonable consumer do in that kind of a setting? Well, Friedman said that what a reasonable person would do is, if they know they're getting a $10 extra this year from the government, they're going to have to pay $10 less in taxes this year, and a year from now they're just going to have to repay it, a reasonable person takes that extra $10 and puts it in the bank. What ends up happening for the whole society, though, is it's not just that they take the $10 and put it in the bank. It's that they take the $10 and lend it to the government. They actually finance the government's own temporary deficit. So if you give people a $10 tax break and you tell them, well, you're going to have to repay this in a year, what people end up doing is financing the government's own deficit. So the private sector pays for the deficit. And how would a reasonable person change their consumer spending plans if they find out they're going to get $10 less in taxes this year and get a $10 bigger tax bill next year? A reasonable person is going to not change their plans at all if they're living in World 1 versus World 2. If I'm living in World 1, I've got some consumer spending plans. Maybe I'm going to spend the same amount of money on, buying electronics and traveling. If I switch to option 2, what am I doing? I am going to save that extra money, not consume it. So a gross oversimplification, and it's a gross oversimplification that is widely used among economists, is that the timing of taxes doesn't matter for consumer decisions. It's the size of the government that matters. It's the lifetime tax burden that matters, not which day the bill happens to show up. So is there any evidence for this fancy, abstract, unrealistic idea that only an economist could love? Actually, I'll tell you one story. President Bush 41, in 1992, was running for re-election, and the economy was kind of weak, and so he thought, well, one thing I would like to do is get more money into people's hands. I've listened to a lot of economists who tell me that when there's more money in people's hands, they spend it. And that spending helps the economy somehow. Okay, so what he did is he changed or made a regulatory change in the IRS tax tables so that there would be less withholding for 1992. So what that means is there's going to be, so less withholding, so people would keep more of every paycheck. But when April 15th of 93 would come around, they'd have to pay that back. So less withholding now, but a smaller refund or even bigger taxes due in 93. So literally a one-year tax cut. Purest example of what I'm talking about. Okay? Actually happened in real life. So economists have gone and looked at this. A lot of folks have looked and said, well, in 92, did the economy do better? Was there more consumer spending? Were people impulsive? Did they reject this economist's fancy idea that people care about their long-run income? they didn't. If you look at consumer spending, a lot of people have looked at this. There's no bump in consumer spending in 92. People saved the tax cut. 1 year tax cut, got to repay it the next year. They saved it. They stuck it in the bank, as far as we can tell. So there are fancier statistical tests you might want to know about. And when they do a lot of these fancy tests, it looks like this story is about 60 to 70% true. So 30% of us just spend whatever money's in our pocket. 60 or 70% of us behave in the hyper-rational, forward-looking way that economists like to think about. Another way to put it is not that 30% of us are crazy and 30% of us are impulsive and 70% of us are forward-looking. Another way to put it is that each of us has some of that inside of us. Each of us is like 70% kind of rational, kind of forward-looking. We don't spend money just because it's in our pocket. We keep an eye on the future. And 30% of the time, we're just a little bit impulsive. Oh, I got a bonus. You get a big bonus, maybe you spend a little of it. If you get a temporary fall in your income, you cut back a little bit, but maybe you'll borrow some money. So you smooth things out. So what this makes it look like, as economists have tried to sum up, what does this say about human beings, the citizens that you're trying to pay attention to? People are mostly choosers. They're not just objects you do things to. They're looking out there, and most of the time they try to behave kind of prudently. I should mention here that throughout I'm citing sources here. I'm putting in very small print. And every single one of these is a source that I think is quite respectable and well within the mainstream of the economics profession. They're not sources that you'd be embarrassed to cite. So well within the mainstream, coming from folks who have great publication records and who are folks that get a fair amount of respect. So what are taxes like around the world? Well, you probably know that the U.S. has a lower tax burden than just about any of the rich countries. We have a smaller government. We provide fewer government services than just about any of the other rich countries. A lot of this comes from the healthcare side of things. About half of healthcare spending in the U.S. is paid for by the government. In other countries, it's much higher than that. So, and surprisingly, the trends over time have been kind of smooth. I mean, so in the U.S., it was 25% of the economy back in the 60s. It's bumped up to maybe 30%, a little bit higher than that now. Excuse me, a touch lower than that now. This is taxes, not spending. In Japan, back in the 60s, things were a bit lower, but now they're sort of catching up to U.S. levels. Other countries a bit higher. The OECD as a whole, which includes a couple of low-tax countries, South Korea, Mexico, Turkey, that pulls down the average. But so the U.S. is a lower tax country than other rich countries. So where do these taxes come from, though? The big story here is that there's a lot of variety across countries. So if you think there's only one way to run a tax system in a modern, dynamic, capitalistic economy, you're wrong. Countries have a wide variety. There's many different items on the menu. You don't just have to pick one thing off the menu. The rich countries have quite a variety. In the U.S., personal income taxes and corporate income, personal income tax is quite popular. Payroll taxes like Social Security quite popular. And this is looking at federal, state, local stuff altogether. Other countries don't have that distinction as much. So, but other countries really like sales-type taxes. Sometimes they call it a value-added tax. Sometimes it's just a straight-out sales tax. So other countries tend to like those a lot more than the U.S. The U.S. just doesn't use that as much. So what's been going on in the U.S. in recent years? Just one last set of facts before we dive back into the what-ifs. About a little less than half of the government's revenue has been coming from the personal income tax. I just pulled this off of the economic report of the president. About 10% of the government's revenue comes from the corporate income tax. About 38% comes from payroll tax, that's Social Security, Medicare taxes, both the employer and the employee's portion together. And then there's some junk. So it's worth keeping in mind that the payroll tax is a flat tax. Right? It's a very, when you look at the employer-employee side together, you're looking at, what, a 15.3% rate generally? And that 15.3% rate, and it's just on wages, not on profits or anything, brings in almost as much as the entire personal income tax combined. I mean, it's a difference, but so a 15.3% rate manages to pull in just as much as a system that has a wide variety of rates, a wide variety of incentives, a wide variety of carve-outs. So it's and it's a tax people just kind of, it sits in the background. We don't even think about it that much. So back to a real economist story here, away from the accounting. Who actually responds to tax changes? There's a lot of discussions out there saying that if you change the tax system, people will change that changes people's incentives, and that changes their behavior. It's probably become at least some kind of a stylized fact that people cart around in their heads. The consensus from a lot of research is that married women respond more than men. So the people in our society who act most like the way economists predict is married women. So it appears part of the reason for that is because they tend to face higher tax rates. If your husband is earning, say, $75,000 a year, he's up in a high tax bracket, and if the spouse chooses to work, then that she's already starts off in a high bracket in many cases. Well, economists have done a lot of work on this, and rather than try to sum up a lot of statistical studies, which are just kind of, you get bogged down in details, you might just try the Who Wants to Be a Millionaire option, which is just ask an expert, right? So that's what I did here, is I just looked at a survey where economists, some top economists, went and surveyed a lot of other top economists and said, what do you think? So what they did is they surveyed tax economists and labor economists at top 40 departments, top 40 economics departments. So this is a handy resource for just kind of keeping track of the conventional wisdom of the profession. So for married women, it looks like if you have a tax cut that leads to a 10% rise in their take-home pay, you're going to get about 6% more work. So it's something you'd notice. For men, the effect is about, men in general, the effect is about 1/3 of that. 10% rise in take-home pay gets you about 2% more work. And now to give you a sense, you might say, well, I don't know if that's a big number or is that a small number? Well, if you're paying a 10% tax rate, let's say your income tax is just 10%. You pay flat rate, 10%. That goes to the government. And the government switches it to a 0% tax rate. Well, this tells you right off the bat what would happen. That would be about a 10% rise in your take-home pay if your rate goes from 10% to 0. And so if you're a married woman, on average, you'd work about 6% more. I'm ignoring some details here, but they're not anything you'd want to know about. But suppose you're in a world where you pay 90% of your taxes to the government. I'll talk a little more about this next time, how realistic or unrealistic that is. Let's say you're in a world where you're paying 90% of your taxes to the government, 90% of your income in taxes, 90% tax rate, and the government says, we're going to cut that down by 10%. So you're going to go from a 90% tax rate to an 80% tax rate. That sounds like a pretty good deal. How much have I increased your take-home pay when I do that? I go from taking 90% of your money to taking 80% of your money. I just doubled your take-home pay. It's take-home pay that matters for people's decisions, at least if you're a reasonable person. Some people probably care about status games, and they like to brag about the number at the top of their W-2 form or something. But a reasonable person is going to care about their take-home pay. So if I'm in a 90% tax bracket, and the government drops that down to 80%, I have doubled take-home pay. So what this tells us is that high marginal rates are, if you drop those top marginal rates just a little bit, that has a much bigger impact on people's incentives than when you drop rates on low earners. The surprising thing is, though, low earners do seem to respond more for a given dollar change in their take-home pay. So there's sort of two sides of the coin here. On the one hand, in the U.S., we tend to tax high earners at higher rates. So if we change their rates a bit, we should get a big response. But on the other hand, when you just look at take-home pay in general, you look at whether your rise in take-home pay comes from a tax change or comes from a bonus you got from work, whatever it was. When you look at it that way, it looks like the low earners actually respond more. Milton Friedman noted something like this decades ago. Low-income earners are just a lot closer to saying, work, it's not worth it. I'm going to go through all this for $8 an hour? Heck, that's quality time I could be spending playing Halo 3, right? So, whereas somebody at the high end, making 1,000 or 2,000 bucks an hour is going to be facing a much different set of decisions. It's going to take a lot more to get them to change their labor supply responses. It also might be that just high-income earners are just people who just have a lot of gumption and are going to work no matter what. They've internalized this work ethic or something. So those individual differences might matter a lot. So, but all these numbers that I'm telling you where you get some effect. If I have a big tax cut and pay for it with government spending cuts, maybe I get a couple % more work out of the American economy. Ed Prescott, who won the Nobel Prize just a couple years ago, he says my numbers, all these numbers that we're talking about here, are a complete waste of time. He says the numbers that I'm using and the numbers that these folks in this survey gave are all off by a factor of about 10. I mean, that's a huge thing, a huge fact. You can kind of Google and look at some of the where this has been debated in the economics literature, but he set off quite a debate. He thinks that the modest differences in tax rates, well, modest, maybe not so modest, differences in tax rates between Europe and the U.S. can completely explain why Americans work so much more than Europeans. So I should point out that there is a noisy minority view in the economics profession, in a very mainstream, a relatively mainstream part of the profession, saying that all of these numbers are way too low. People much more respond to tax rates. So if you're going to use that kind of a story, some economists would be much more comfortable saying that there's some kind of social story at work here, a social multiplier. You often hear economists talking about multiplier effects. $1 spent gets passed on. Well, there are also social multiplier effects that could be important in something like the world of taxes. Perhaps if one person gets a tax cut, that makes work seem a little more attractive to that person. And then maybe you like doing what your friends are doing. So if you like doing what your friends are doing, then that one person who decides to work a little more might set off a small increase in the incentive for all their friends to work or your neighbors to work. If all the cars are gone in your neighborhood between 8 a.m. and 5 p.m., you might just decide, well, maybe I shouldn't be sitting here all day playing Halo 3. So if social economists don't know a lot about these social forces, we're getting a little better. Maybe another 5-10 years we'll know more about that. We'll have a story for whether Ed Prescott's got enough to explain a lot of this. So there's some other harder to measure but still important things, and economists aren't really great at this stuff. When you have high tax rates, there's probably more tax evasion. And when you've got high tax rates, there's a lot more incentive to call up your tax accountant and say, isn't there some way I can get out of this? So I'll talk more about that tomorrow. So taxes on capital are something that get talked about even more probably around here in this town than taxes on labor. But first let me tell you a little bit about the facts of how much of U.S. income is going to capital and how much is going to labor. The surprising thing is that these numbers that I'm putting up here are the same everywhere. Across the rich countries, and even across the vast majority of very poor countries, about 2/3 of income is in the form of wages and salaries, about 2/3 of gross domestic product. About 1/3 goes to capital. It's in the form of interest and rent and profits and capital gains. Well, you can't use capital gains, actually. Dividends. And the shocking thing is that this is true across time and across countries. Just looking at, like, if you just went into a poli-sci course or an American history since 1945 course, you would see all of these dramatic political changes that have changed in the U.S., where we've gone from politicians on the left running things to politicians on the right to people in the center. We've had the rise of unions. We've had the decline of unions. You would have thought that somehow all of these grand political battles, these passionate fights that people have had that occupy so much of our time in the newspaper, occupy so much of the efforts of academics, would actually show up somewhere in the government statistics. You would hope that it would, but it hasn't. 2/3 going to workers, 1/3 going to the greedy capitalists. That's your number. The change is 1-2% over a decade. Now, these percentage changes are tiny. Perhaps even more shockingly, the division is the same between the U.S. and Europe, and roughly speaking, across all the rich countries. I mean, all it takes is you just open the paper up and you hear that European economies, they have these pro-worker policies. They have strong unions. They do a lot of things to help out folks. It seems like they're taking the side of workers a lot. This doesn't show up in this number. Maybe it shows up in income. This doesn't. Notice this hides the rich versus the high wage earners and the low wage earners. They all get lumped in that 2/3 number, right? No, excuse me. I really should have changed this. This is like my prelude to taxes on capital. This is GDP, 1/3 of U.S. income. One-third of U.S. income, of the entire U.S. GDP, is going to capitalists, 2/3 going to workers in wages and salaries. So I should have changed the title on this. So I would have thought that these numbers would be different across time and across countries. This seems like a fact that economists actually use this fact as a starting point for any discussion. So, like I said, this camouflages changes in wage inequality. Barry Bonds, he's part of that number up there, right? So his income doesn't show up as that, by and large. But the split between workers and capitalists is astonishingly. I don't know why this is. Economists have these kind of cheating ways of trying to explain why we think this is, but if you can come up with a way to explain this for real, you could get yourself a Nobel Prize, I think. So if you got an idea, let me know, and we'll write something together. So this number's been checked out a lot of times. So let me tell you another shocking thing that I was surprised to find was true. There's a shockingly robust result from pure economic theory. I'm not one to use a lot of pure economic theory to argue points, but this one it's something you can't get away from. When you walk to a chalkboard and write down a model economy with people who are selfish and workers who like higher wages and capitalists who like more profits, just very reasonable assumptions. And you write down, you run a little model and say, well, who should pay for the government? Who should pay for the government? Even better, who should pay for the government from the workers' point of view? If the workers are the only ones who get to vote, what would they vote for if they were rational and looked at the long run and whatnot? This is a shockingly robust result, which is known as the Chomley-Judd result. If you just Google Chomley and Judd, Chomley's a rare enough name that you're not going to get a lot of other hits. You'll find that since the mid-1980s, when this result was first proven rigorously, our profession has spent 20 years beating our heads against this because a lot of people don't want to believe this, right? It just doesn't sound right. It just sounds mean. So this result is that taxing capital income is generally a bad idea. And capital income isn't capital gains taxes. It's a small part. Corporate income taxes, interest taxes, profit taxes. The U.S. actually does do a lot of things to make sure that this stuff doesn't get taxed. And IRAs and 401ks do a lot of that. Actually, Ed Prescott, the same Nobel Prize winner who thinks he can explain why Americans work so much more than Europeans, he also thinks that the massive size of U.S. IRAs and 401ks and other tax-preferred savings vehicles are big enough that we're actually pretty close to this world, he thinks, of not taxing capital income very much. So he may be right or wrong on that, but he's been vocal about that. So so the key point which I'll hit on in the second slide here is that in the long run, the revenue raised by a capital tax isn't enough to make up for the lower wages that it causes. So, and even the surprising thing is that this isn't a counsel of perfection. This isn't. I'm not saying, well, it's better to have no taxes or all taxes are bad or something like that. It's nothing like that. It's that even a distorting labor tax, workers themselves would vote for a distorting labor tax over a capital tax. So here's the intuition of a kind of tough mathematical proof. Higher tax on capital. The first point is obvious, right? You tax something, you're going to get less of it. Okay, whatever. So there's fewer machines to tax. So you're not raising as much money to give to the workers. So if you just imagine, we're going to take all this money and we're going to hand it to the workers and see if we can make the workers better off. Here's the subtle point. Fewer machines means that workers are going to produce less, which means they get lower wages. So if you think that the average part of what determines the average worker's wage in the U.S., whether it's salary or hourly wage, if you think that a big part of what determines that is the machines you have to work with, if you think part of why you get paid more is because there are a lot of machines around in this country, then that second point is kind of important. So when these guys save less, that actually hurts their wages. Fewer machines to work with. So and here's the surprising thing. I actually made an Excel file that was a simulation of this, so my PhD students would get the intuition here. Even if you took all that capital tax revenue, like you say, a capital tax can raise a ton of money. It can raise a ton of money. Even if I take every single dollar of that and divide it up among the workers, say, oh, you all get this. We took from the capitalists and we gave it to you. Here you go. Spend wisely. Go buy some stuff. They're actually poorer. They would rather have the higher wages. They would rather have the more machines and more wages, more private wages. So if they had a vote, sometimes this is called the limits to redistribution argument. So, and Chomley and Judd, Chomley actually proves this the most, but it's been proven like a lot of times since. So, like I said, a lot of the profession beats their head against this and tries to find ways around it. And there are some interesting ways around it, but they're sort of interesting in the sort of pure theory kind of sense. They don't seem to be as interesting in the this matters for the real world sense. So, well, that story only holds true in the long run, right? It takes a long time to wear down all those machines. In the meantime, the machines can produce a lot of output. So that's a long run story. But in an open economy, where machines can move across countries, businesses can save more in another country starting next year, the long run happens a lot sooner than you think then. So this is where, and there's another rich literature, empirical literature on what's known as tax competition, where countries are concerned about the fact that if their tax rate on corporations or on capital is higher than in other countries, that all the machines and all the businesses, all the headquarters will move somewhere else. Now, of course, politics people are driven to hyperbole, and they think everything's going to pack up and move tomorrow or pack up and move next year. In real life, things might be a little more sluggish than that. There's a lot of sluggishness in human behavior. But one summary of this that's from Michael Devereux at Oxford. You can find other folks in literature on this. Jane Gravel over at CRS has written some interesting stuff on this, which you can pull up. It looks, when Devereux tries to sum up the literature, again, I'm trying to tell you here's what the consensus is from the profession, not just what one or two people that I cherry-picked are telling. Devereux finds that more open economies do tend to have lower corporate tax rates. Countries that feel the sting of competition tend to have lower tax rates on corporations. They feel that burden a little bit more. But the funny thing is they don't have lower corporate tax revenue. And Jane Gravel's study, the CRS one, which you should all be able to pull up off the CRS website, finds the same thing, which is surprising, that there's not much of a link between the tax rate and the tax revenue. So is this a free lunch, which a lot of economists would be skeptical of? You can just pick whatever tax rate you want. You're going to still be able to raise the same, like in the U.S., 10% of government income comes from corporate taxes. 10% of federal government revenue comes from corporate income taxes. Can we just pick whatever rate we want and basically raise that same 10%? So is this a free lunch? Or is it that countries that choose high rates end up giving a lot of loopholes, a lot of incentives to sort of counterbalance that? As you can imagine, economists are a little lazy when it comes to collecting this kind of data, so it'll take us a while to collect like real facts on that. But it's a library of research. But it's kind of a surprising fact. I wouldn't have expected that. So, well, what a lot of people claim is that lower taxes cause faster economic growth. Lower tax rates across the board, lower tax rates on capital, however you measure it. Some people say, well, you'll get richer in the long run if you do that. So one way to check this is to do cross-country studies and look. You have to throw a lot of bells and whistles in these statistical tests. You look at cross-country data and say, are the countries, holding other things equal, are countries with the low taxes doing better economically than countries with the high taxes? It's a muddle. This literature, which Hendricks and Miles in their textbook kind of try to sum up. They sum up what I'd seen in the literature, which is that it's just kind of a mess. Sometimes you can see results making it look like low taxes help economic performance. Sometimes it looks like that result kind of goes away when you look at it in depth. And you might think, well, maybe the real world is just too complicated. Maybe different countries just are different in so many ways. It's hard to tell what's really important for making one country richer than another. But Salah E. Martin at Columbia University is famous for running literally millions of statistical tests. He wrote a paper called "I Just Ran 2 Million Regressions." So he ran millions of statistical tests to look at this kind of stuff. And in a 2004 piece, he, which the less exciting title, Determinants of Long-Run Growth, where he only ran like 20 million tests, I think. It's kind of low. He found these things really mattered. So some things do really matter. K through 6 education, the price of machines and equipment, investment rates, whether you have malaria in your country, whether it's part of the reason apparently African countries are poor is just that malaria just makes it hard to get things done and makes it hard for people to organize together. Being close to a coast is good. Number of government employees, or roughly speaking, the size of government consumption. It's kind of the number of government employees. That seems to be bad for long-run economic performance. That's kind of robust. So these things are kind of robust. But the actual level of your tax rates doesn't seem to be that robust. So it's been tough to find really solid, big picture evidence. So the evidence that I've been talking about is stuff built from the bottom up. What do I think individual folks are doing? When I look at the big picture stuff, it gets a lot blurrier. So one possible reason you hear in the literature is that maybe it's because it's hard to measure what the tax rate is. Just look at how thick the Internal Revenue Code is and try to say, if I'm going to boil that down to one number, what number would it be? And imagine having to do that for every country in the world. That'd be hard. No, but corruption measures do. People put corruption measures in separately, but you're right. It would be important to measure like what the tax code is in theory, and then versus what the tax code is if I slip $20 to the IRS guy in my particular country. You're right. These corruption measures, corruption is a hot topic in economic growth research. But the interaction between taxes and corruption, no. Nobody's done that cross-country. So another possible reason is taxes just don't matter that much. So maybe it's all a waste. So one way to get at this answer is to, ask the experts. Ask them. So I'm looking at that same survey as before. And this survey of tax economists, they asked them, what if we went from the U.S. of today and switched to a pure consumption tax? There are a lot of different ways to do a pure consumption tax. I'm not going to talk about it in detail, but you can have a national sales tax. That's one way. You can have something called like the USA tax, which came out in the late 90s, which looks a lot like our current income tax, but just make sure that you can always pull out all of your savings. That never gets taxed. Or you can have some kind of income tax with full expensing. That's something like the Hull and Rabushka flat tax. So you expense all of your capital equipment instantly. Deduct it the first year. There are a lot of ways to get at that. So if you just ask them, what if we switch this, what would happen? The average answer among these folks is you'd grow about 0.2% faster a year. That strikes me as kind of unnoticeable in the short run. But in the long run, it would make you 10% richer. It would make the entire economy about 10%. So you grow 0.2% faster for a while, and then it kind of slows down. So according to standard estimates, that would make you about 10% richer in the long run. I don't know, maybe 3 generations. This is a debate, yeah. 3 generations. So maybe 2, if you're optimistic. If you go out and look in this survey, these the folks who did this, Fuchs, Poterba, and Kruger, they actually broke people into sort of the 50th percentile, the 75th, and the 25th percentile. The pessimists, the economists who were pessimistic thought that it had basically no effect. The optimists, though, you might want to keep an eye on what they're thinking. They thought maybe the effect would be a little more than twice as big. That'd probably be noticeable in the long run. If you grow half a percent more a year, for a couple of decades, and then it kind of peters off, you'd be about 25% richer in the long run under standard estimates. So you probably noticed that. Again, there's so many other things happening in the U.S. It might be hard to see the forest for the trees if you were actually living this in real time, but that's part of the reason you spend a little time at the chalkboard to check these numbers. So that gives you a rough idea of where this looks. So 2 slides left. So a lot of the debates in this town are not about what the effective taxes are on the economy, but what the effective taxes are for the government, right? I mean, you work in a government town, so you probably care most about the government. So the debate this often goes by is dynamic scoring. So should the government take account of the fact when it's changing its tax code of the fact that it's going to change how people behave down the road? And that might affect how much taxes the government gets down the road. Well, the person that's most famous for this, the name that's associated with the most, is Art Laffer, the famous Laffer curve, which I'm not making a copy of. You can Google that anytime. In a Time magazine interview just the other day, which you can pull up on their blog, he said this. He has a reputation of saying, tax cuts might pay for themselves sometimes. He says, I've never said that all tax cuts pay for themselves. That's probably kind of obvious. I never even said Reagan's tax cuts would pay for themselves. That's just something to keep in mind. But there are some caveats here. If you actually look at the profession, I think you'd see most economists saying it's more important for capital than for labor for some of the reasons we saw before. Mankiw worked in the Bush Council of Economic Advisors. He was the chairman. Has a paper that tried to come up with mainstream estimates of how important dynamic scoring is in practice. He found, just using a model that any of us use, we all learn it in our first year PhD programs, that a capital gains tax cut should cost about 1/3 less than advertised if you offset it with spending cuts. So, or if you offset it with some kind of much better tax increase. So a capital gains tax cut might cost a little bit less than advertised. Labor tax cuts might cost, at most, maybe 1/6 less than advertised. So that gives you a rough idea of what the consensus of a mainstream off-the-shelf model would be. And throughout, he tries to stick with mainstream off-the-shelf models. Another point of view would be to go ask Brad DeLong what he thinks. So Brad DeLong worked in the Clinton Treasury. He's been a prominent blogger since then. He's a very influential economic historian and macroeconomist at UC Berkeley. So DeLong, on his blog just a couple days ago, says, as I read the evidence, Laffer is probably right at the top end, and right in this traditional Laffer curve sense. When we reduce the top rate from 70 to 50%, which is what happened in 1981, when the top rate was dropped to 70 to 50%, that's probably a revenue gainer and surely not much of a loser. So that's what DeLong thought. From 50 to 28% is, I think, a big revenue loser. We'll talk about the 50 to 28% tomorrow. So rates that are looking like that 70 to 50%, I think that's a safe assessment of the profession as a whole. It's going to be too hard to find too many people outside the mainstream, too many people within the mainstream who would be supporting rates up in that range, that 70% range. Probably a revenue loser. Discourage so much behavior, just encourage so much tax avoidance, so much tax planning, some of which we'll talk about tomorrow, that it doesn't even raise you any money. Just to sum up what I think are the biggest points, looks like tax systems really differ across countries. There's not just one way to do these things. So when you're thinking about how could the world be, one way to look is to look at the chalkboard, ask a bunch of theorists how they could change the world. Another way is to look out your window and see what's going on in other countries. The U.S. is just a sample size of one, and the sample size is much larger than that. It looks like consumers, as spenders, don't respond much to one-time tax shifts. If you give them a tax cut this year and they're going to have to pay it back some point in the future, it's not going to change their consumer spending much. But if you cut taxes and people know, oh, government spending went down too, that'll change their behavior. Men don't seem to respond much to tax rates when it comes to labor supply. They might respond some. Married women a little more, but again, Ed Prescott thinks that I'm completely wrong. He thinks that all these numbers are much bigger. And he got the trip to Stockholm and I didn't, so. Right? And savers do seem to respond the most. And IRAs and 401ks, which are very popular in our country, really are designed to take advantage of that fact, that people do pay attention to savings incentives. So this is what I'll be talking about Wednesday. And I hope you enjoyed your time here. And if you have any questions, I'll be sticking around for a few minutes. Thanks very much.
All right, we're now going to open up the floor for questions, or if you'd like to schedule a conversation with Dr. Jones, please let us know. And also, please do take a moment to fill out the green forms because they do help us.
Oh, so full expensing is when you are able to deduct the full cost of a business machine the year you buy it. So how do businesses pay their profits tax? They look at their sales, they subtract off all their costs, and they pay a tax on the difference. So if I sell $1 million worth of stuff, I spent $500,000 on wages, I can deduct that, I only pay profits on the rest. Governments come up with rules for what else I'm allowed to deduct besides just my wages. And one of the rules are, and nowadays, is that if you buy a machine, you have to spread that cost out over a course of years. So if I buy $1 million machine, I might have to write it off over 10 years. I can only, on my taxes, deduct 10% of the cost each year. It spreads it out. Full expensing would say I can write it off right now, instantly. So it's basically about getting paying lower taxes right now in the year that I buy the machine, rather than paying lower taxes spread out over many years. That's what full expensing is about. Yeah. Yeah. Oh, okay. I'm going to repeat your question. So if 2/3 of income is going to workers and 1/3 to capitalists, then are the capitalists continually increasing? Basically, are they increasing their how much they own all the time, right? So that they're.
Well, I'm saying, money, they're gaining money. Is someone losing?
Oh, well, capitalists spend their money. That's the thing. I mean, capitalists go and consume things just like everybody else does. So workers spend their wages to buy goods and services. Capitalists spend their profits to go buy goods and services too. I mean, so that's one point to make. Another point to make is that both capitalists and workers can save some of that money to build up their capital stock in the future and to build up the number of machines and equipment we have. So I guess to say the key point is they're a loser. It's more like the opposite is true. If we can get them to, if I can convince rich people to consume less and save, then that means we'll have more machines and equipment in the future, which means that I can have a robot doing half my job someday. Yeah. So what I want is for all of you people to be foolish enough to save, right? And so you build up a really high-tech, super advanced economy so that I can go and consume a lot of awesome things, right? So that's what I'm hoping for, is a world like that.
You mentioned that married women, at least under your numbers, tend to respond more positively.
Yeah.
Lower rates, or bigger take-home pay.
Yeah. They respond more than men, it seems like. In most cases, I can caveat it up.
And I'm just wondering your thoughts on why you started to suggest that it has to do with women married to rich men, which is really like
A small, yeah.
Most married women, most women in general, don't earn a whole lot. So I didn't know whether there was a thought as what's behind the women responding more positively.
I think part of it is that women see themselves as being, married women probably see themselves as being able to go in and out of the labor force much more easily. They're just paying attention to incentives. Economists usually write down models where people pay attention to incentives, and it's perhaps no surprise that perhaps married women are more rational, and men are just these creatures who just must work. I mean, it could be a question of taste. It could be something, whether it's biological or cultural, that just men are just like, I got to work. I'm between the age of 25 and 64. I'm going to try to find something to do. So I don't know how much of it is taste and how much of it is that more narrow focus of the marginal tax incentive. So, yeah.
It seems like everybody is pretty universally lamenting the low savings rate.
Mm-hmm.
Why is the savings rate so important in the scheme of what we've been talking about?
Well, yeah, the U.S. seem to have a very low savings rate. Part of it may be because we're measuring it wrong. I haven't gotten into this debate at all, but our measurements of national income don't include capital gains. Okay? And Robert Hall, who I mentioned before, Robert Hall of Stanford, he argues that if you really want to measure GDP right, capital gains are really part of what we're producing. And so when your home value goes up, that's a form of saving. The Federal Reserve has been paying attention to these numbers the last few years. They probably were paying attention to it for a long time and just didn't talk about it. So a lot of the ways we save don't show up in the official government numbers. Increases in stock prices, increases in home prices, they feel like saving to me. If I see that my stock portfolio goes up, I feel like, wow, I'm richer. I'm not spending it, so I must be saving it. So it might be because we measure it wrong, or because the low savings rate could be because Americans just enjoy are impatient, impulsive people. So they're taste stories and they're big grand theory stories to explain it. So, yeah.
Quick question on the, well, maybe not that quick. The taxes on capital slide, you talked about 2/3 of income, wages and salaries, 1/3 capital, interest, rent, profits.
Yeah.
You said it's the same across countries. And I'm wondering if there's been any analysis at the marginal effect of the demographics of an aging population. For instance, Japan, Italy, and Spain have much, people who work a lifetime generally have more capital.
Yeah.
People who are just entering the workforce generally have zero capital. And that has implications as we have an aging population in the industrialized world in terms of income equality and in terms of possibly this dimension, although my sense is that as the labor force shrinks or is stable, you pay higher wages to attract more workers into the workforce rather than just having them earn off of income, so there's a balance in all sorts. Any research, any thoughts on that?
So your question is about whether the stable 1/3, 2/3 capital wage ratio is perhaps sensitive to demographic changes in the economy. And the question of the size of the capital stock, how many machines and equipment we have overall, there's going to be a big demographic story there, right? You're right. Aging populations need to build up a lot of machines so they can do a lot of the work when the population's too old. So we'll have robots to take care of us when we're in our nursing homes, hopefully, right? But I think that's a separate question from whether the ratio of profits to income. So profits are a flow, capital is a stock. It's like the water coming into the lake versus the amount of water in the lake. All I can say is when you look across countries, that ratio of profits or capital to income is stable across the poor countries and the rich, and those include a wide variety of age spectrums. So the poor countries tend to be young, as you know. And the rich countries are getting older, and I don't see any trend in that. So.
You mentioned that workers would vote, and rational workers would vote to reduce tax on capital.
Yep.
And that's the way they would vote. I'm assuming that I wanted to confirm this. You're saying the study showed that would be better off because in the end they get more money overall.
Yes. If you care. Mm-hmm. So the question is about the Charlie Judd result that you can't redistribute income to workers on net. Yeah, if workers only care about their take-home pay, their private wage plus the money they get from the government, the way to make that number biggest in the Charlie Judd story is to have a zero capital tax and have as much machines as possible and no income redistribution to workers. So if workers only care about take-home pay, then they would rather have the big private pay is better than a small private pay plus the taxes from the rich, taxes from the capitalists. I should be clear. Yeah, and again, I'm shocked by that result. But you look at the math, and you're like, you just don't. It's just too easy. It's so surprising result.
It's like a national sales tax on your board's book, whatever. With that, is the concept that would make people more rational to save more and more, and we get how would we make up? Or what's the best way to make up that the taxes you get from it?
So the question is about a national sales tax. Well, I mean, you could come up with a national sales tax that would replace everything we've got if you wanted to. The question of whether people would start evading it a lot is a big and important question. But any of these is just another kind of consumption tax from my point of view, from the macroeconomist point of view. You know, from IRS's point of view, it's a very different story, right? The distributional consequence is a very different story, like poor versus upper income people. But if I care about the effect on capital, I've just got to be looking at these numbers. So if I care about how a switch to a consumption tax, whether it's a national sales tax or something else, I can lump them all into the same bin from my point of view as a macro guy. And the impact is something you might notice. Depends on whether you can see the forest for the trees. Yep.
Wasn't there a paper recently that called into question the zero corporate income tax rate in light of the consumption tax that's full expensing?
So you asked about whether there's a paper that calls into question whether you should have a zero corporate income tax.
In light of having
A zero capital income tax.
like a full expensing.
Oh, okay. So so again, these are sort of, well, I guess I can say microeconomist questions, right? Which way if you decide you want to go to a consumption tax, there's more than one way to do it. And full expensing, being able to deduct your machines all in the first year is one way to get at that. Having a zero corporate income tax would be another way to get at that, but you'd have to do some other things as well. And those are questions about like tax administration, whether you can keep an eye on the money, whether people are going to be able to create more tax shelters and start calling something that it isn't. So I know a little about that because of my time on the Hill, but not enough to say anything valuable. So that's why, fortunately, the last day we're bringing in a tax lawyer who knows those kind of things vastly better than I would. Any other questions? All right. Well, thanks very much.